On today's show, we will be learning the basics of technical analysis. My name is Candace, and we will begin right now. Technical analysis, or TA, is the study of the movement of an asset's price while using patterns within the movement to predict future movement. If we boil the price movement down to its simplest form, it is merely a reflection of the buying and selling of that asset. Taking another step back, the buying and selling is caused by how people feel about that market. It is a response to the investor's psychology. Human psychology tends to move in a predictable pattern. Thus, that pattern translates all the way back up to our charts and is why we can use TA to make predictions. But when you look at your assets, you will see different types of charts. A line graph is one of those types, but for TA, another type of chart is much more useful, and that is the candlestick chart. At first glance, the candlesticks look like a mess of red and green rectangles with lines we call wicks sticking out of their top or bottom. Sometimes the wick is bigger than the rectangle, and other times there are no wicks at all, or just a wick on the top or the bottom. It can be confusing the first time you look at a candlestick chart. However, it is not as difficult as it initially looks, and in fact, understanding how to read a candlestick chart will provide you with lots of information that can be used in TA. Over on the chalkboard, you will see a pair of candlesticks that we can examine to cover the basics of how you read them. First, you will notice that we have two colors, red and green. The green candlestick is an upward movement of the price, while the red candlestick is a downward movement of the price. That sounds pretty easy. The entire length of the candle from wick to wick, or just end to end, represents the time frame you are viewing. So if I say we are looking at a one-day candle, then the entire length of that candle would be a one-day time frame. I could have easily said the 4-hour candles, and yep, you guessed it, the time frame would be 4 hours for each candle in that chart. So for the rest of this video, we are going to assume that our time frame is on the one-day candles, meaning it will cover an entire day. If we look at the very top of the candlestick, so the end of the wick or the top of the body, if there is no wick, it shows us the highest price your asset reached in that time frame. Conversely, the bottom shows the lowest price. On our one-day candles, the top is the highest price for that day, while the bottom is the lowest. The solid body is the overall price movement for that time frame, or in our case, for one day. The solid body will start at the open price and end at the close. If the close is higher than the open, it is a green candle. If the close is lower than the open, it is a red candle. If we look at a green candle, if the price never goes below the opening price in that day, there would be no wick on the bottom. Also, if the price never goes above the closing price for that day, there would be no wick on the top. The same is true with a red candle. If we never go above the open, there is no wick on the top. And if we never go below the close, then there is no wick on the bottom. It is sort of the opposite to reflect that the red and green candles are moving in opposite directions. Interestingly, the smaller the time frame on the chart, the greater the chance for you to get candlesticks without wicks. What about the wicks? On a green candle, a wick on the top means that the price went higher than the close price and then dropped back down to the close price. With a wick on the bottom of a green candle, it means the price dropped below the open price but returned above it on that day. Otherwise, it would be a red candle. Now, of course, on a red candle, a wick on the top means that the price went higher than the open price and then dropped back down below the open price. Otherwise, it would be a green candle. With a wick on the bottom of a red candle, it means the price dropped below the close price, but closed above it on that day. Once we understand the basics, we can then look at candlesticks and how they fit together. This is going to tell us a price movement story. Once again, over on the chalkboard, we will use this small chart sample to apply the basics we just looked at to a closer to real life example. The first thing you may notice in our example is that the lengths of the candlesticks can vary in size. This reflects the buying or selling pressure the current asset is experiencing. So a longer green candle would be experiencing more buy pressure than a shorter one. Conversely, a longer red candle would be experiencing more sell pressure than a shorter one. Let's move through the example on the chalkboard. The first candlestick is green, meaning its close will be higher than its open, and we can see that is true. It opened its price at the bottom and closed it at the top. It also has no wicks, so we know the price did not go below the open or above the close. For the most part, the movement was up, though there could have been some down movement that did not go below the open price before it moved back towards the close price. The next candle, it too is also green, but this one comes with a wick. The body of the candlestick is smaller than the first green, thus we know there was a drop in overall buying pressure compared to the previous day or the previous candle. The price opened where the previous candle closed. From the wick, we know how high the price went before it came back down to the close. Seeing that the next candle is red, it is a good guess that the price may have happened towards the end of the day. However, it is just a guess, and using a one-day time frame, the price may have shot up to the top of the wick earlier in the day, then fell back down below the close and rose to meet it. Of course, if you really need to know, just look at the chart on a smaller time frame like the 4-hour candles. Up next, we have a red candle with a short body and a large wick. The bigger wick on this red candle indicates that the price dropped well below the close during that time frame and eventually rose back up to where it did close. The next candle is green, and it is the biggest of the green candles, so it had more buying pressure than the first two green candles. The bottom wick means the price dropped a little below the opening price, and the top wick means that it rose some above the close price. The final candle is red with no wicks and is bigger than the previous candles, thus we can see an increase in selling pressure. It more than likely had a steadier movement compared to the shorter candlesticks. Once you have the basics of candlesticks, the next stage on our journey into TA is to understand highs, lows, and the trends they form. It is very important to get a grasp on the overall trend of the market. Is the market trending up like a bull, or is it in a downwards trend like a bear? When we first look at a chart, we will see ups and downs, and from first glance, it can be very hard to determine the overall trend. When we look over on the chalkboard, our example has an up and a down like a hill, but is it up or down overall? The answer is that we really don't know for sure, so we need to zoom out and look at a bigger picture so we can use the highs and the lows of this price movement to help us. So now that we are zoomed out, it is easier to see the highs and lows in this chart. A good rule of thumb is that when you have higher highs and higher lows, you have a market that is trending upwards or bullish. If you have a trend of lower highs and lower lows, you have a market trending bearish or downwards. So always be asking if the highs are getting higher or are they getting lower? And also ask, are the lows getting higher or are they getting lower? Sometimes you need the help of a trend line to help you figure out the answer. If you draw a line through the highs that touches as many highs as possible, then look at the slope of that line. If it is going up, so are your highs. If it is going down, your highs are making lower highs. You can do the same thing for the lows. On the chalkboard, our highs are increasing as well as our lows. Thus, this is an upward trending chart. We can utilize these highs and lows to make our trend lines. Not only are these trend lines important in seeing our overall trend, but the price reverses at these lines. If a line through your high sends the price back down, it can be thought of as a line of resistance. If the line through your lows sends the price back up, it is a line of support. These trend lines are key to determining support and resistance levels. Always remember, when making a resistance line, we plot a straight line through the highs, looking for a line with the greatest number of highs touching it. The more touches, the more reliable our resistance line becomes. Each touch is evidence of that resistance, as these spots stop the rising price and sent it back down. In our example, we have 4 touches to this line, which is very good indication that we have found a solid resistance line. Conversely, we only have 2 touch points on the support line through our lows, which makes it a weaker support. You will also notice that there were more than one way we could have drawn this line to hit 2 lows. For that reason, we cannot put a lot of trust in the support line until we have a 3rd touch. Usually, when a line can equally form 2 different patterns, you need to further zoom out to see if you can get a 3rd point for either of the patterns, or you need to wait for more of the support line to reveal itself. So that is pretty simple once you get used to plotting your support lines. But what exactly is going on at these lines? That answer is all about probability. These support and resistance lines are the probability of a price reversal at that point. In the case of a high, it hits the line or resistance, and if the probability of breaking through is 25%, then it will reverse the price down 3 out of 4 times. Keep in mind, probability is never exact as each attempt is not aware of the results of the previous attempts. This means there is no guarantee you break through on the fourth attempt. However, once you do break through a resistance and then close a full candle above that resistance, it will usually flip that resistance into a support, which can help the price stay above that line and give it a chance to consolidate before moving upwards. With lows, it is the same, though in the opposite direction. The lower support keeps redirecting the price back up until it breaks through to the downside. After a full close beneath the support, it flips to resistance and makes it harder to return to the higher prices. Generally, if the probability is low of breaking through the upper resistance, it will be higher for the support, meaning there is a better chance of breaking down to the downside in that case. Don't get caught up yet on probabilities, as that is something we will cover in a future video. Down below is my Patreon, which is a great way to support the channel and gets you some exclusive content. I also have a link down there to our Facebook group, which is one of the best ways to know what is going on and mingle with the community. If you like this video, please hit like. If you want to see more content like this in the future, then hit that subscribe button and hit that notification bell if you want to be the first to know when I drop a new video. Thank you for dropping by, and until next time, I bid you a fond adieu.